in from 96 until 2000. And I remember the whole world was upside down then, because my job as a venture capitalist was to convince the companies to take my money, as opposed to the other way around.
I think it's also happening now. So
Yeah.
we could start now. There will be a lot to talk to you. So no, welcome to this webinar. Today we are delighted to have Bob Liao join us and talk about this really important topic, which is how to analyze and value tech companies. And Bob has been a top-ranked tech analyst in Europe for over 20 years. We were just chatting that he has been an analyst covering venture cap companies during the tech bubble. He has covered small cap, large caps, hardware, software, payments, the whole shebang of the list of companies. He's also helped a lot of tech startups raise money. So he's a really specialist in terms of how investors in early stage companies should think about it, especially the companies who are planning an IPO, which I know is a question which I get a lot from investors and companies in Pakistan. So Bob, thank you for taking your time. I know you have an extremely busy day, and I'm sure the last few months have been extremely busy for you given what's happening in the tech sector.
Yeah, no. In fact, I'm in the middle of two tech IPOs right now, so it's definitely a hot market.
No, absolutely, and then for me, it's a pleasure to be talking to you. You're a friend and somebody who I respect immensely. And these webinars are for me a way of connecting the global experts such as you to people in Pakistan to learn from what's happening in the world. So I'll kick off with the first question, Bob. What's happening with the valuations? Where are we right now? I left tech 3 years ago, and at that time still Visa was at 15 times EBITDA, and most tech companies were like 12 times, 13, 15 times EBITDA earnings. The good ones were at 20 times, which were growing at 20 times earnings. So for me, the standard framework was 20% revenue growth, 20% margins, and put a 20 times one-time tech multiple on them. So it was like kind of a fair multiple. But where are we right now?
Yeah, I mean, so much has happened really in the last 12 months or 18 months. And it really comes down to 2 or 3 factors, really. One is the massive drop in interest rates that we've seen in the market. And that's been a huge boom for growth stocks in general, but in particular tech. And so it's just, simply a derivation of your discounted cash flows. If you're using a discount rate that's now going to be 300 or 500 basis points lower than they were before, then you're willing to pay for earnings, 10 years on. You're almost valuing those earnings 10 years on at the same rate as you're valuing the earnings 2 years from now. And so generally for all growth companies, that's been a huge boom compared to companies without any growth. So that's one factor. And the second factor in the boost to tech valuations is obviously the lockdown and the pandemic. And that's accelerated growth rates immensely. So, in many sectors, from video gaming to even hardware and PCs, they've all seen a massive boost in growth rates. And the general view is that while, some aspects of tech are expected to sort of recede and slow down after the pandemic is over, there's definitely a view that it's a permanent shift as well, a permanent shift in growth rates. And so that sort of acceleration in growth, people are not just applying to year 1, but to year 2, year 3, year 4, and not sort of assuming that we just go straight back to historic growth numbers. And so that's accelerated the growth expectations, and hence the multiples that people are willing to pay for them. And I think those are the 2 sort of main factors driving valuations up over the last 12 to 18 months.
So where are the valuations now? In Europe, the space you look at, where are these companies trading at?
Yeah, it varies quite a bit. We do a quarterly review of the tech sector, including valuations on different subsectors, and I must say it varies dramatically. So we cover everything from digital media to payments to video gaming companies to software, enterprise software, and the valuations range dramatically. But I would say that it's like you said, 20 times EBITDA would have been sort of a very healthy multiple back then, and now it seems it's normal and average. And if you're doing really well, then it's well above 20 times EBITDA that you can expect. And I think there's a real, having said all that, and I'm thinking about the last quarterly review of valuations we did, there is a big difference in valuations from company to company based on quality. I think particularly the European markets, counter to, I think, what a lot of people believe, that the American markets are willing to pay a higher multiple. I think when I look at the range of companies in Europe, that you have a wide range, and those companies that really prove themselves on the London and European markets are able to get valuations that are equal to the ones that are in the US. And so you can easily see, payments companies with, something like an Adyen with, 60 times, 75 times EBITDA. That's something that's probably might not even be matched in some of the American markets. But I think the difference is, I think it's people will give those multiples, but to the higher quality side of the spectrum. And so you see, I think there's a lot of companies that will have, what seems like a discount to some of the valuations that are out there, for example, in the US, because they haven't quite proven themselves to a lot of the investors in Europe. But once that happens, then you definitely get the same sort of multiples that you see in the US as well. So yeah, the valuations are very, very high. I think they're well supported by growth right now, and by earnings reliability.
If a company, let's say, if you mentioned Adyen, which of course is trading like close to 70 times EBITDA multiple, is that an outlier? So if a company comes to you, let's say a software company, it makes software, let's say it's a company making $50 million revenue that makes software which is used in some area of fintech, let's say auto finance, auto leasing financing software. So similar to the company listed in UK, I think you might have worked on the IPO of that.
Well, Auto Trader.
Not Auto Trader. The company which does software which is used for mortgage or leasing auto lease calculation, and the name will come to me.
No. Yeah.
I think JP Morgan did the IPO. So let's say a software company, fintech space, recurring revenues, $50 million revenues, let's say 20% net margins. So with $50 million, what will you recommend them in terms of what should the valuation they should look at?
What sort of, so we're talking 20% margin, EBITDA margin?
Let's call it 20% EBITDA margin. Yes.
Yeah, and then growing what at the top line?
Growing by 30%, $50 million revenues.
Yeah, look, I mean, that's and if that will get a very high multiple.
What? You have to advise them for IPO. They've come to you. So what will you advise?
I'd first have to say it depends. But you can easily get above 20 times EBITDA on that type of profile. And how much higher would depend on what sector we're looking at. If you're looking at a company with, like you said, a high portion of recurring revenues and growing that recurring revenues at 30%, then you will to get higher than significantly higher than 20 times.
So 20 times is the base. 20, do you think for a growth company like that, a software company with a 30% growth, a base multiple to start the conversation would be around 20 times EBITDA?
Yeah, I would think so. I mean, if you look at sort of a bottom sort of level benchmark, it's quite interesting. In the UK, you look at the enterprise software market, and that market's, many of the companies there in the UK and Europe are not fully sort of SaaS companies. They're more traditional models, and they serve maybe a niche enterprise software market. And the growth is not astronomical. It's sort of high single digit growth. Top line.
What's a good growth rate? What's a good growth rate?
Oh, I think a good growth rate is definitely 20% is a sort of a good benchmark. But I'm just trying to set a lower benchmark. If you look at those companies that are only growing high single digits on the top line, but they have a very solid margin, good recurring revenues, so good quality business, but people aren't paying for the growth. They're just paying for the sector, so to speak. You're still looking at 15 to 20 times multiples. I mean, maybe not 20 times, but closer to above 15, usually 15 and maybe high teens. And so if you can, on top of that, demonstrate that you maybe have a bigger addressable market and have maybe much stronger growth, then you should be able to get a premium on that type of multiple.
What about SaaS? We were discussing this before the call formally started. How should we look at SaaS valuations?
SaaS, wow, that's a special case.
Yes, absolutely.
And you'll see that the SaaS multiples are incredibly high for the bigger companies. We're looking at above 30 times EBITDA for some of them. Now, if you look at the profile of SaaS companies in the US, and like I said, I just did a valuation exercise for a private equity firm for SaaS companies, and many things to note. One is that in Europe there's a real shortage of SaaS companies. There's not a lot of SaaS companies listed in the European markets, and so there's a real hunger for them. And I think there are some that are private ones that are about to come onto the market. And if we do see momentum there, I think there'll be a huge thirst for those types of companies in the European market, because we've obviously seen it in the US. That's one point. So I think there's a bit of a scarcity premium in the European markets for SaaS companies. And if you look at the US, there's been a huge sort of move to invest in SaaS companies. When you look at valuation of SaaS companies, a lot of them have come onto the market without any profits, actually. And so, the exercise or the profits are at a very, very early stage. So they might be making 5%, EBITDA margin or even lower. But everybody will recognize that, with that model, with the growing user base that they have, all those SaaS companies eventually, it's a matter of, it's like all platform companies, they'll eventually get to, 40% EBITDA margins or even higher. And so makes it very, very challenging to value on an EBITDA basis. And what we've found when we've done a more quantitative review of the sector is that EV sales is actually a better measure of the valuation of these businesses. And what we take a look at, obviously we just don't look at EV sales and sales growth alone. What we also add is the dimension of margins. So we take a look at, I think we did some regressions between EV sales multiples and a combination of EBITDA margin and sales growth. And so you might have some companies that are more stable. You have Salesforce.com that, might be growing at 10%, which is slow in SaaS world. But they have like, a massive margin of, 50%. And so combined, that's, but then there's something that some companies on the other side of the spectrum that might be growing 75% on top, but their margins minus 10%. And so if you combine those two together, you could see a EV sales multiple that's probably the same for both, the high growth, low margin company and the low growth, high margin company. And that sort of, so then I would say then, if you're a company in the SaaS market, then you do need to be, cognizant of, in order to maximize valuation, obviously you want to be generating high revenue growth, but, you want to demonstrate that your margin potential is there, and that, people will penalize you and reward you for your percentage EBITDA margin as well.
What's the average in this trade-off? Like, what was the average multiple? EV to sales.
Yeah, in the SaaS world, it's easy to, it's not hard to get to 10 times sales. That's again, there's all sorts of factors that drive that. So I'd caveat that. But that if you do look at the regressions, then 10 times sales, for a average SaaS company is not too far off the mark. What really makes the difference is people will then take a look at the next level of analysis of the company, and they'll look at the average or annual recurring revenue, the ARR, rather than the total revenue. They'll do multiples of that, and then they'll also look at a lot of the stats around the customer base is really important to SaaS valuations, in terms of the churn rates, in terms of the new product adoption. So, can you cross-sell more products into your existing customer base and increase the average revenue coming from each of the customers? What's the net effect of churn versus, new products? All that has a huge impact on what sort of sales multiples you might apply to a SaaS company.
Got it. So total thank you for that. So you're essentially saying that for a SaaS company, the starting benchmark for an average SaaS company, let's take it 10 times EV to sales, and then you put a premium on a discount depending on various factors such as how much of the revenues are recurring, what's your margins, so into the profitability, client concentration, and all that stuff. So it can be a premium or a negative. No, so Bob, just to give you some background, like the reason I'm emphasizing on these things, that in Pakistan, like we are starting from a very low base in terms of like market appreciation of the tech companies. So like, a couple of years ago, tech companies, you would treat a tech company the same as an oil and gas company, or actually you'll treat it worse because they don't pay dividends. So because you don't pay dividends on a DDM, you would see analyst notes saying, oh, I don't like this company because they have never paid a dividend in their life. So that's why I'm asking you some basic questions, which I know that you will find it very like basic, but for the audience, like I just want you to say those out so that they kind of understand where we what's the framework which we are looking at. What about the likes of Sopra Banking, SAP? So the software companies who make software which are used in banking, in retail, in e-commerce. So not the consumer facing companies, but the enterprise software companies like SAP or a Sopra or a Temenos.
Yeah. No, I mean, a lot of that, people still love those businesses because they're very, very sticky in terms of customers. And long term, they've got fantastic asset light businesses, high margin. I think the big focus, I would say, that a lot of investors have right now with respect to those types of companies and what differentiates the ones that are really highly valued versus those that are not, is the addressable market. If you look at some of these businesses, they sound fantastic. They have they're sort of well positioned in their markets, and they've got good management, good business models. But in the end, they're addressing a real niche. At first, it might seem like they're a big big sort of market that they're addressing. But when you look at their product and where they can realistically compete, etc., maybe it's a certain size firm that they sell into. It's a certain size product that is a certain type of product that they're successful with, and then market size gets shrinks, and then the valuation definitely shrinks. But if you're looking at businesses, people are very much focused on addressable market right now, and if you can demonstrate your addressable market is a big one, you can demonstrate that you've got a good position there, then people will be willing to draw that straight line to the right. So I think addressable market's probably one of the most important things in terms. So you get a wide range as a result of valuations. Stuff that's really sleepy, and you're still dealing with legacy sort of type markets, and those things will still they could be 10 times EBITDA. I mean, sorry, even less than 10 times EBITDA. And then others that'll just be huge multiples of sales because of the market that they're addressing.
Thank you. That's a very great point. Thank you for highlighting that. So people look at total addressable market, and you estimate that how tangible that is, and then you estimate how much share can this company gain of that total addressable market. Yeah. And that's how you kind of get to, and you're willing. So for example, because that's a great point, because interestingly, most Pakistani software companies are actually not targeting just Pakistan. Most of their businesses are targeting the global market. So the clients are like the tier 1 US companies in retail or in banking. So their total addressable market is not constrained by the size of Pakistani market. They're actually
that's really helpful. That's really helpful. I mean, even it's not just Pakistan. You look at the UK. There's UK enterprise software companies, and there's a big difference in valuation when a software company can penetrate and be successful, proven to be successful in the US market. Immediately, the valuation rises because one, the US market obviously is 5 times the size of the UK market, but equally important, it gives the software credibility, global credibility. If it sort of wins in the US, then it can win globally, and there's a broader potential associated with that.
Thank you, Bob. You work in VC space as well, and that too during the tech bubble. So that bubble world. How do you compare the 99, 2000 times versus the current times, both in terms of where the valuations are and also in terms of the overall capital which is available to invest in these companies? Yeah. If this is the bubble, where are we in the bubble stage?
I would say that I don't think we're anywhere close to the irrationality of the bubble that was in 2000. In 2000, we saw a lot of companies that, had no credibility, no product really, being listed and valued solely because of what their business plan was. We used to say, it's slideware is all it was, is all they had, not software. It was. That was still being developed. It was just slideware was the only asset these companies had, and it's not like that now. Now I think there's undoubtedly the tech companies are expensive, but I think there's good knowledge of the companies. People understand what's a good quality tech company. People understand if a tech company doesn't have a realistic shot at a market. But I think, what I would say though is that, valuations overall are still very, very high right now, are very, very high compared to history, obviously. But, I think I would say that on a relative basis, then I would say there's, the market's being very, very sensible. They're discerning between a good growth company, a high growth company, a slow growth company. They're discerning between a quality company and a low quality company. they're discerning between a company with a big market and a low market, a good management team and a bad management team. You go back to 2000 and there was no
Interesting.
no discerning. It was sort of, we'll put the money was put everywhere and anywhere, and it didn't really matter. So I think it's a much more rational business. But I think because of the immense amount of liquidity in the market, I think it's a tide that's lifted all boats really.
So coming on that point, that tech, of course, now is 30-40% of the total index. So how much liquidity is there now compared to the past 5 years? I'm no longer talking to the tech fund, so I don't know, what's happening in that space. But have their AUMs grown much larger? Do you see more interest generally in tech?
Yeah.
Than the 5 years ago?
Yeah, no, I think I guess to answer that question, one is how much interest is there on the public market side, and how much is there interest on the private market side? Because it's important to, even if you're only focused on the public markets, you need to understand the private markets, because they're now competing for the same investments. And so I've had a number of IPOs that I've been working on over the last year that have just been acquired by private equity instead, and decided not to IPO. And so some of those companies, the public markets won't pay the same type of multiples that the private markets will pay. But then there's other companies which is the other way around, where private equity seems to be happy to pay those multiples and the public market's not really interested. So I think it depends on the company where there's more liquidity on the private versus public market side of things. But on both sides, there's still incredible interest in tech. I think that if anything, I think I don't see a slowdown in more money being shifted into the tech sector. I think we've seen a lot of money recently going into what the market calls value stocks instead of the growth sector, and so they've received a boost. And sort of, I think there's a lot of commentators that are saying, oh well, the valuation gap between value and growth is at historical highs. Saying both that the growth stocks are overvalued and the value stocks are undervalued. But I don't. What my sense is, or at least talking to fund managers, I don't see a rebound to value. It's not like I'm seeing fund managers suddenly turn to value stocks. I think it's more so what we're really seeing in the market is that there's fund managers taking advantage of cyclical stocks that happen to be lowly valued, and they're playing the cycle, and so that, I think there's a difference in that, because what that means is that there's not a shift in money from growth to value. It just means that there's more money being put into cyclicals, but it means growth is still in favor, and I don't think that's going to change.
So you think that's a very interesting point. So you're saying essentially sectors which are structurally considered to be bad, they are not attracting investment,
That's exactly right. I don't think there's suddenly I hear a lot of managers wanting to play oil and gas because it's cheaply valued. People want to play it because of the cycle, but I wouldn't be surprised if after the cycle is over, we get back to more of a growth focus.
That's very interesting. And that, of course, the big question is about fossil fuel. That is that a distress? Is that a structurally a sector which is gone structurally because of green and renewables, or is there juice left in that? And do you play the distressed trade?
Yeah, I mean, we've seen huge increases in alternative energy companies. So everything from hydrogen to batteries to more traditional renewables as well. huge interest and different companies coming onto the market. I mean, I'd say that you know, of all the sectors, I think, you know, that's one where, you know, I think there's a lot more speculation than there is in some of the companies that I focus more on in terms of the software sector and even SaaS and whatnot. I think it's much closer to being a conceptual stock, I'd say. Sorry, let me just get rid of that.
Is the market doing the total addressable play over there? They're looking at the total addressable market and saying, okay, let's play that, because the total addressable market is so huge that even if we get it wrong, like some stocks will do better in that.
Yeah, I think that is exactly right. I think people are just speculating. You know, it's still very early stage for a lot of those technologies, and it's almost impossible to figure out the, you know, the shape of the business in 1 or 2 years time. But I think investors are sort of just planning that, you know, or investing in the sector by looking at the big addressable market, like you say, and thinking, okay, well, I don't know if it's going to take off in 2 years time, but I'm pretty sure it'll take off in 5 years time. And if it does take off in 5 years time, I think it'll be a huge market, and this company is really well positioned. And so even if they get 1% of this market, it's a wonderful business that they'll have in 5 years time, and therefore I can value that. I think is the expectation. But you know, there's a lot of ifs there. But
I suppose the returns are asymmetric, right? The return rewards are asymmetric, that the upside on success is just so huge that you are willing to take that risk of it going to zero because of the asymmetry in return. Like the return is capped, the loss is capped at zero. It cannot go below zero.
But absolutely. But you know, it's interesting. I mean, you know, I imagine, you know, again, you always have, when there is a lot of money sloshing around, you will always have you'll always have good and bad. And, you know, like I said, there's a rising tide lifts all boats, including ones that probably shouldn't be lifted.
True. You know, well. I remember like 4 or 5 years ago, I think we were, or maybe even 6 years ago, when we were looking at that Loughborough hydrogen cell company. I've forgotten the name, but at that time the company couldn't raise any money. But I'm sure in this time period, that company would have been a darling.
Absolutely. I mean, you know, but it's interesting because, you know, timing is everything with the markets, and you know, this is certainly true of valuation. I remember when I was in venture capital, I invested in hydrogen companies back in the late 90s. And it's funny because I look at some of the business plans now and I think, wow, I saw a very similar business plan 20 years ago. But, you know, it was just way too early back then. But I look at the business plan now and it's like, well, that's much more realistic. You know, so it's timing is everything. And look, timing is everything in terms of the market, clearly. You know, the sort of, for example, with hydrogen, there's just a greater acceptance of it and a greater understanding of it. But what's very important with respect to valuation is not just the timing of your fundamental market and fundamental market demand and addressable market. Equally important is the capital markets and what kind of mood the capital markets are in. You know, I think, you know, like you said, I've been in the business for, you know, as a research analyst for 20 years. And I'd say for, you know, certainly for a minority of those years, the market's open to IPO. You know, in most years, it's not. In most, you know, in terms of really open. Obviously, you know, what investment bankers will always say is that if you're a good company, we can always IPO you, which is true. But, you know, it makes a huge difference if the market's behind you, even if you're a good company. And I'd say, you know, the market's definitely open now. But my only sort of caution is that they won't always be open. And I think in most cases, you'll find that you'll find them closed in many cases. a majority of the time.
So let's do it. I asked this question to you earlier, but this will be my last question, and then we'll be open for Q&A. And for people on the call, if you have questions, please write it down on chat, and I'll read them out for Bob. So Bob, if I'm a software company, let's say I have $50 million revenues, I make software which is used in, my clients are large retail companies in the US, banks, and I provide them software which they use. It's recurring, so 90% of my revenues are recurring. Let's say my net profits are 20% margin, so I make 10 million in profits, and I'm growing by 30%. So let's say 80% of my revenues are in the US, 20% are in Europe. I'm growing by 30%. My net profit margins is 20%, so I make 10 million profits. What's the valuation? If I come to you and say, hey, Bob, I want to go public in London, what's the valuation you think I can get? What's the valuation you think I can subscribe to? And I'm a really good company in terms of corporate governance and all that stuff.
Right. Look, it's going to be, I couldn't tell you the precise multiple, but I can probably say that it's above 20 times the EBITDA. And
what about net profit? So like PE multiple?
Gosh, I'm a tech analyst.
I don't look at
far down the statement. No, look, it'll be a much higher PE multiple than 20 times, obviously. I think
what, like really ballpark, like, you're having this conversation, I'm thinking about IPO, I say, hey, Bob,
yeah,
what's my company worth?
I can easily see 30 to 40 times.
30 to 40 times.
Yeah. It's a great profile company. It ticks all the boxes, and what I think, investors love to, they overfavor the high quality companies like that. If there's a little bit wrong with it, it's surprising how much of a discount people will apply for just one sort of, red flag or whatnot. But if you're sort of really consistent, recurring revenues, strong top line growth, good cash conversion, good management team, good margins, if you're ticking all those boxes, then it almost reverses, and it's like, wow, why would I not invest in this? You're asking yourself. And that's when the floodgates open for because then every single phone call I make to investors, they're all lining up.
What about dividends? Do the investors ask you that, does this company pay a dividend? And if a company pays a dividend, how do investors treat that? Like, I remember at SafeCharge, we had a dividend yield of 5%. And your favorite company, PaySafe, didn't pay any dividends. Yeah. And I know how we used to get penalized. Our investors Absolutely. Used to say, "What the hell are you doing? You are paying a dividend? You have a 5% dividend yield. Get out of this room. I want PaySafe, who does not pay me any dividend." So how is it?
It does seem counterintuitive, isn't it? So I think broadly the answer for most growth tech stocks is that dividends don't matter. I'm just thinking about all the stocks that I look at, and dividends really don't factor into the fundamental valuation. I think they only matter is if there has been an issue with the company in the past, and investors want confirmation maybe on the quality of revenues or whatnot. They want to, if they see a company paying a dividend, then they'll say, oh, that gives me reassurance that it's that those reported earnings are what they say they are. I think in those cases, then certainly dividends make sense. But on the whole, valuing certainly an earlier stage tech company, or even a more mature tech company, that dividends don't matter very much. If anything, like you said, it's the reverse. Because the investor's mindset, or the growth investor's mindset, is if you're paying a dividend, that means that you don't have any good place to put your money. You don't have any good investment opportunities, which means you don't have many good growth opportunities, which means I don't want to invest in you. And that's the mentality that they have.
That's a great point. If you don't want your own money to invest, why do you want other people's money to invest?
Exactly.
Last question from my side. Sorry, I'm being a bit greedy. Growth versus profitability trade-off. What do investors value more? I know you said that it's a curve, it's a trade-off between EV. So if you plot EV to sales multiple, growth on one axis and profitability on one axis, it will be a curve. But what's valued more one-on-one?
Yeah. I think the ideal scenario. So I think if you were to push me for one answer, I'd say growth overall. But what I'd also say though, or how I would answer it, is that I'd say, people will accept your growth and be willing to pay for that growth and not be too concerned about profitability if they're confident in the trajectory for the profits. So if you come to me with a company and you're saying you're going to grow 50%, but you don't think you're going to make profits for 5 years, your break even is not for another 5 years. I'd be like, okay, maybe come call me in 2 or 3 years, and then we can talk. But if you come to me and say, okay, well, maybe, not 30% growth, but well, I can do 20% growth over the next 5 years per annum. And, I'm going to be break even in 18 months or maybe 2 years. And I can show you that we're on a very strong trajectory to get there. So last year we were losing lots of money. Now we're, at minus 10% margin. Next year we're going to be at -5, and the year after that we're going to be at +10, whatever. If you can draw that outline, then I think that's ideal. Then it's like, okay, I'm willing to pay that. And then if you can demonstrate that you're a business that fundamentally is able to generate big margins. So you're an asset-light business. You've got, lots of operating leverage. You've fully invested in your platform, your software platform. Then, all of that growth that you're projecting, all of that addressable market, all of that's going to fall to the bottom line, or at least that's what I'm going to be thinking as a fund manager. And therefore I'll be confident in making that investment. But, again, so I think the growth is more important than the profits, as long as you can, draw or get the investor to be confident that you're on that trajectory to profits, and that you've got a good margin that you're going to eventually get to.
And just for clarification, the multiples we have spoken in this call, are we talking about like current year, forward year, like when we said 40 times earnings or 30 times earning PE, was it for this year? Because in Pakistan, actually people look at trailing multiples. So that's
yeah, no, I'm definitely not looking at trailing multiples. I'd say that either it's your first year forecast, or might even more often than not, it's your second year forecast. So if we're already, right now I'd be looking at 2021 as the earnings base. But as we move to May, June, when I'm pretty confident in 2021 numbers, then I'd be looking at 2022. So it's always forward, because the investor kind of thinks, okay, look, what's already baked in? If 2021 is already baked in, then I'm willing to take the risk on 2022. So it's always forward.
Great. Thank you, Bob. Now we are open for questions. So if you have questions, please write it down. Madhya is also on the call. Madhya, can you hear us? You are on mute, so you'll have to unmute yourself.
I can hear you guys. Hi.
Okay.
Hey, Bob.
Hi. Very good to see you.
You too. Absolutely wonderful.
Yeah, it's great.
So I don't have a valuation question, but I have something more of a broader question. Just generally, when you're looking at what tech companies in the US and Europe, anywhere, are actually exciting you right now? Any ones in particular on a 3 to 6 month view?
Yeah. So I'd say there definitely anything SaaS is hugely attractive in Europe. I'd say marketplaces are still hugely popular. And so some people don't necessarily think that they're on the fringe, they're on the fringes of tech. So I'm talking about like, you know, some of the e-commerce-y type platforms, like your, you know, food delivery, your property marketplaces, online classifieds, as some people would like to say it. Those companies, hugely popular right now. And
Bob, give us names. So Madhya and I, you know, used to remember talking to you about Bango, I think 5 years ago. So give us names. Don't you know, shy away from
so in Europe, it's companies like Rightmove that that has, you know, there's companies like Just Eat that is growing very strongly. There's bigger conglomerates like Schibsted in Sweden. A lot of those platform marketplaces, hugely attractive, because, you know, one thing that they offer that even goes beyond what some of the software companies offer is they've got network effects, because it's like the bigger they get, the bigger their competitive advantage, and the bigger they get, it's a virtuous cycle, and the margin is just, you know, Rightmove is on a margin of 75 to 80% EBITDA margin. So
wow.
Not bad.
Not bad.
But yeah, so those types of companies are hugely popular right now, marketplaces, because they're asset light, they're huge margin potential, they've got network effects. Platform, big buzzword, platform businesses.
Okay, interesting. Thank you, Bob.
Well, thank you. I just thought that, you know, I'll get Madhya to say hello to you, because so Madhya used to do Asian equity sales at Macquarie when Bob was there as a tech analyst heading the European tech team over there. So we are open for questions, please. Somebody has raised his hand. I think it would be much more easier if you type the question down in chat and I can ask that question to Bob. That's the standard format which we've always followed in these webinars. What about, Bob, have you looked at e-commerce, warehouse, logistics plays? Is there any listed one in Europe? So like Kerry Holding in Hong Kong, and there's a company in Brazil which is in that space.
Do you mean the actual warehouse owners?
Yeah, so people who are doing delivery, last mile delivery, as well as the warehouse things. So like a combined play end to end.
No, but we haven't seen that. We've seen definitely sort of warehouse owners, and they're considered property companies, and they're doing very well. All their stocks are above where they were before the pandemic. Now, as far as sort of logistics sort of stuff, I mean, a lot of that is hugely popular right now. I mean, one IPO that's coming up is the Deliveroo IPO. They have they do delivery of takeaway, but they also own a bunch of kitchens. So they own the kitchens too. So they're almost competing with their client base in some respects. And that IPO is probably one of the hottest IPOs this year. But in terms of other logistics that get a bit more techie, also hugely popular, company called Ocado that does essentially it's robotics, and so they do they mechanize or all of the operations in picking groceries, packaging them, and sending them off, shifting them onto trucks, and it's all done automatically. It's an incredible business. I mean, you can imagine they own these warehouses where their goal is to not need to turn the lights on, and the warehouse continues to work because it's 100% robots.
Where are the multiples on that? So EV to sales multiple. Any idea?
It's a good thing you didn't ask for EV EBITDA multiples, because there definitely isn't one.
Totally. But I think the good point is that, as you highlighted earlier, that it seems as if investors are very discerning, as you said, right? It's not that you put the same multiple on every company. Even in the same sector, investors will be looking for quality. And if you do prove to be that quality company, then there are companies like Adyen, which is trading at 70 times EBITDA. And similarly, in the SaaS world, what's the highest multiple you've seen in terms of EV to sales? I'm sure.
Oh gosh, wow. I don't know if there's much of a limit, really.
Really? Okay. So people are really playing for quality right now.
Yeah, I mean, look, I think I don't. The quality point that you raise is super important. I think you have to remember that investors have a lot of choice when it comes to investment, and very often in the world of small cap, you're not you're not dealing with experts in technology overall. These investors will invest in a robotics company, but they'll also invest in a clothing retailer at the same time. So they're not spending their whole days focused on tech. And so as a result of that, when they hear technology and they see technology, and someone talks to them about robotics or semiconductor chips and throw all of these acronyms around, the investment manager will say, "Oh gosh, I don't really feel comfortable with that." And when they don't feel comfortable with, the proposition, then what do? They'll invest in the one that's the highest quality. They won't take the chance. They'll say, "Okay, look, I might not understand it completely, but I'll invest in the biggest one in this sector. I'll invest in the one that everybody else is invested in. I'll invest in the one that has the reputable management team." And all those things make a big difference because you're not dealing with an expert. You're dealing with, they're not there, figuring out whether the code on the software is good or not. That's not how they invest. They're there saying, does the management sound convincing? Does the addressable market sound good, sound big? Does the proposition sound convincing? Would I buy it? Well, really practical questions like that. And that's what determines the quality of the business to them. And I think they'll overpay for the higher quality business.
Got it. So somebody told me that the chat box is disabled, so they cannot type the questions over there. So if that's the case, then if you have hands raised, then I can ask you. There were a few hands which were raised. I don't know why the chat box is disabled. Taha, can you check that? But I do see some questions, hands raised. So perhaps we can start with Hassan. I'm trying to unmute you.
Hi.
Hi there. Hi, Hassan.
Hi, how are you?
Very well, thank you.
So I had a question specifically for valuations regarding software companies that have separate back offices, like a BPO sort of a structure. How do you evaluate those type of back offices if you want them separately, for example?
When you say, do they have a outsourced IT operator? Do they provide BPO service to other companies?
Yeah.
Does that mean?
Yeah. So it's leading from the example that Ali Farid gave. So imagine a company that is providing software services to the US market, but it's based in let's say Pakistan or India, the back office, and it has a front office in the US.
Like Tata Consulting Service. Like Tata Consulting Service or Accenture.
Exactly.
Yeah. Okay. No, I think those, so that would be classified as software services business, and in general, they're valued at a lower multiple than software companies, definitely. And the reason for that largely is that there's not a lot of leverage you can get on scale. A software business, I write a bit of code, I sell it to the whole world, and that bit of code I can just repeat again and again and again, and I can sell it I've got zero marginal cost on it. Whereas if I try and resell the services again and again, then there's cost associated every single time. And so the multiples are much lower for it. And there, you're looking at, definitely a focus on how fast you're growing. If you're not growing quickly, then you'll have quite pedestrian multiples, probably not even really techie type multiples. It'll be much more driven by growth. If you can demonstrate growth, then I think you can get a decent multiple out of it.
Tata, I don't have the numbers right now, and I have access to Bloomberg right now, but like Tata Consulting Service is now the largest IT services company in the world, 163 billion market cap, bigger than Accenture. So you're right, like it's in terms of growth and in terms of the incremental margins which you're looking at and the total addressable market and how much recurring the businesses are. I think the chat box is working now because I do see them.
My only warning, Ali, is that I've got a hard stop at noon. That's all.
Yeah, so you have only 6 minutes left, so I'll have to choose some question. I'm sorry about that. What's the right multiple for a company that has more inward-looking model, only caters to a certain country market? And so what about a company like an integrator of SAP? Because so somebody buys the software from abroad and just integrates it over there.
I think it depends on, the stage of growth of that business. If it's a business that is quite mature and already they've got all the major sort of customers in that country, and they've penetrated most of the market, but they're now generating hopefully very wide margins, then you get a good valuation because you're generating lots of profits, but your multiple is going to be quite a bit more moderated because your growth opportunities are quite limited. But you take that business, a similar business that it's only just starting to penetrate the market, adoption rates are still limited. If you can demonstrate that even in a particular market, whether it be Pakistan or whether it be the UK or India, if you can demonstrate that we're at the early stages of adoption and there's many years to go in terms of reaching saturation of the market, then you can get a very high multiple on it, even though the addressable market might be a bit more limited.
What about AI? What's happening in AI? What's the multiples on that?
AI is tricky. I mean, everybody wants to invest in AI. It's funny, and people are like, "Oh yeah, give me exposure to AI." But there's very little that we can invest in AI, and most of what people are doing to get exposure to AI right now is mostly investing in hardware, usually semiconductor type chips that are specifically engineered to process massive amounts of data. And that's how they're playing AI. But if you look at service companies, for example, there's not a lot in the market. Like people would point to IBM as an AI sort of having good AI services, but there's a lot more to IBM than AI. So investors don't really see that as a proxy for the sector, and so it's hard for them to get exposure to it. I'm actually working on one AI company, services company right now, and they're migrating their migrating their services to become more productized. And I can tell you there's lots of interest in it. So the AI.
What will be the multiple for that? So a company like that?
Oh, I can probably tell you in about 2 months' time when we IPO it, but.
But Palantir would be a benchmark, right? Look at Palantir as a benchmark.
Yeah, it's in this case here, it's still it's a money losing business, so it's going to be on a sales multiple. It is definitely higher risk because it's still in the transition stage from a services company to a product company, and so investors are not going to pay product type multiples, software multiples, until they prove that their software is successful. And so they'll give them a slight premium on a services multiple for a high growth services company, and maybe a bit of a premium for eventually getting to a software business. And so I think we'll see, but it's a tough market.
I'm just conscious of time. The last question. Emerging market discount. So if a company is global, has global clients, but it happens to be listed in Pakistan or an emerging market, so let's say India or Eastern Europe, and what will be the discount for that? Will investor put a big discount on where it's listed?
Yes, Yes, and I think there's I suppose valid reasons and invalid reasons for that. The valid reasons are if I'm sitting in the UK as a global fund manager, I'm going to have a lot more comfort if I can if my CFO or the CFO of the company is sitting in the UK as well, and I can call them up anytime, same time zone, and complain to them about what they've done. It's a lot harder for me to do that if there's a language barrier, if there's a time zone, if there's multiple, miles between myself and the company I've got my money in, and there's a whole different sort of jurisdiction. And then part of it is just uncertainty about the business, greater uncertainty, and that's valid as well. So I'd say definitely there's a discount, but I think it's a shrinking discount, but there's definitely a big discount still.
Thank you, Bob. I know you have another meeting starting now, so
Gotta run.
we'll probably request you for another time for all of these questions. There are a load of questions which are on.
All right.
Thank you.
It was great chatting with you, Ali.
It's my pleasure. Thank you. Take care. Have a lovely day.
You too. Bye-bye.
Thank you. Bye-bye.
Thanks, Bob.
Bye. Bye.
Bye.